Thank you for being with us. This panel of Motor Valley Festival is going to be all in English. I guess you've got the translation, and we're going to talk about the financial valuation of automotive sector and some startups on financial markets, especially in the USA, compared with the traditional one of the automotive sector. We've got some very big specialists with us. I'm Dario Donato. I'm a financial journalist from Italian bigger private broadcaster that is Mediaset. My sector is financial, not automotive, sorry, but financial in general and economics. And so here we are with the presentation. Beside me, there is Regina Savage, Global Head of Automotive and Mobility Technology of Morgan Stanley, directly from Chicago, I guess. Thank you for being with us. Also, Gianluca Camplone, Senior Partner, McKinsey, specialized on vertical automotive. Thank you, Gianluca, for being with us. Do we have already the, we've got Sturzer Georg. I guess, I hope the pronunciation is well. Georg, sorry, industry expert automotive from UniCredit. Thank you.
Good afternoon, it was okay.
Good afternoon, and good afternoon also to Enrico Chiapparoli, CEO Barclays Italy, and he's also a private investor, a business angel. Thank you, Enrico. Good afternoon.
Good afternoon, everybody.
So I will start with Regina. Could you please tell us what is your view about the automotive sector in this moment, also the financial valuation that we've got on financial markets, especially in the USA, starting from the USA?
Sure.
Okay, it's gonna work? No.
So I think we're at a period of really extreme disruption for the automotive industry overall. You've got the incumbent OEMs realizing that they need to shift their business away from the internal combustion engine and move to electrification, and that requires a tremendous amount of investment. On top of that, you have this move towards connectivity and other technology in the car, such as autonomy, and that also requires a tremendous amount of investment. And then you have an industry which has actually had a fairly static set of players over many decades. You know, there's been some changes here and there, but you have, you know, incumbent players with very few new entrants, and now you have this rush of new entrants who are sort of upending the overall dynamic. And under that backdrop, so you need lots of capital, it's becoming more competitive, and the industry is transforming. You have a financial market environment where the investors recognize that these trends are coming. They want to invest in them. They are hungry for growth and looking for pure play opportunities to invest in that disruption. And they have a bigger appetite for risk, especially if it's a liquid investment that they can sort of move in and out of if they feel the risk needs to be moderated. And so that has created this fertile ground for a lot of these companies, especially as new entrants, to raise capital from the public markets at fairly attractive valuations. In some areas, you know, hard to justify from a fundamental valuation metric. And, you know, that is a backdrop that I think the incumbent OEMs are struggling with. How do they compete? They have a very different cost of capital, a different ability to raise capital, and yet they have the same challenges. In fact, I would say harder challenges because they have to transform their existing business. And that's the backdrop that I think we find ourselves in overall. And you know, while the new entrants have sort of dominated the capital raises to now, I would say that the incumbent OEMs are not sitting back on their heels. And I expect you'll see them take more innovative ways to raise capital to fund these types of initiatives. You've seen it already with the autonomous vehicle subsidiaries like GM using Cruise and raising money separately at Cruise. I think you'll see continued attempts by the incumbent OEMs to try to raise capital for some of these efforts directly in a way to keep pace and compete with the new entrants.
I think that everyone is asking himself if we are quite living in a bubble, no, Regina? I mean, as we passed through in 2001, because if you look at multiples, for example, Tesla or other companies that are investing in electric vehicles, they've got multiples that are completely out of any logic, we could say, no? If compared with traditional one. for example, Ford or General Motors, even though now they're quite investing, I would say also communicating a lot on electric new technologies and investing. But do you think that we are living in what could be in the next future a bubble or not? Or it's the future, and so multiples are guaranteed in some sense?
I'm not sure I would use the phrase bubble, but I would say that clearly some of these players, especially the new entrants, are trading at very lofty valuations, and not all of them are going to be successful, right? Let's take the LiDAR sector, for example. There are multiple players that are public in that market. Several of them trade at really significant valuations, even though they're pre-revenue or early revenue. And it's not possible for all of them to be as successful as they claim to be. It's a competitive market, and it's the TAM is only so big. And so some of those are by definition overvalued because they won't be that successful. But some of these players will be. And so for those players, it's not an over-exuberant valuation. If you believe in this disruption, if you do a DCF, it actually implies valuations much bigger for some of these. The question is, which ones are the winners and which ones are the losers? And are those numbers risk-adjusted, make sense in today's market? And in some cases, they don't. But I think the way that participants are playing it is almost a portfolio approach, especially for these pre-revenue companies, where they don't all have to be winners, because some of them will win very big, and some of them will fail. And it's almost a venture capital or portfolio approach, but done in a public market context. What is difficult is that when you look at the incumbent players who don't benefit from that sort of dynamic, and there clearly is a big value disconnect between them. I would say that some of the incumbent OEMs have made real efforts to take advantage of that and try to improve their efforts. So you've seen Volkswagen, General Motors, and Ford, for example, do really forward-looking stories about how they're going to transform on electrification and connectivity. And when they've done it in a credible way, the markets have started to reward them. And what we've heard from investors and in those contexts is, wait a minute, I could invest in a new player who has never made a vehicle before, or I could invest in someone who does know how to make a vehicle, so that part of the story is de-risked. And if I believe they really are committed to electrification, this is actually really cheap relative to some of these new entrants. And so I think, it is hard to say all are overvalued. Certainly some are. And I would argue that if you think that some of these incumbent OEMs are going to be successful in transforming themselves into, big electrification players, they're undervalued. And so it really does, you really do have to sort of dig down into the market a little bit more deeply rather than just sort of saying it's all a bubble.
So I'm going to address to Georg Sturzer from Unicredit. We've been passed through very hard times with the pandemic, Georg. So I would like to ask you, what is your view about the performance that the automotive sector had in these last few months, in the last year and a half, I would say, on the financial markets?
Mm-hmm. You're right. It was really a terrible year. But at the end, it was managed surprisingly well, we have to admit. And if we look back at 2020 on a full year basis at the financial accounts, you don't see any large effects on the financials at the year end 2020. But if you look into more details during the year 2020, you see how critical the situation was. And the new quality of the COVID crisis was that we had a complete shutdown of production facilities and also of dealer network at the same time. And this created problems which we haven't seen even in the financial crisis. And to assess the final impact on financials of the COVID crisis, we have to separate a little bit between the operating performance of the industrial businesses and the impact of working capital, which became during last year, or which gained a new dimension due to the structure of the shutdown situation. If you look at the operating performance of the OEMs and of the suppliers, it was really solid from my perspective, as many companies have worked on their cost structure, increased the variable cost base, lowered their break-even. So the operating losses and also the negative free cash flows just coming out of the operating business were lower than expected from my perspective. In contrast, we had this topic, working capital, which became for many companies a much bigger problem. And there were two reasons for this. The first one was due to this sudden shutdown, we had a high level of inventories at the end of the first quarter, but this solved very quickly due to the reduction of inventories and the cash generation from the start of the second quarter onwards. But we had then the second reason for working capital becoming a huge problem was that some OEMs use the approach of a negative working capital in the automotive business. And this strategy is usually based on huge trade payables versus suppliers and very long payment terms. And this strategy was followed by the two French OEMs, former two French OEMs and Fiat Chrysler. And this had a tremendous negative impact during the second quarter. And this is important to understand from my perspective. Just to give you an example, let's use Fiat Chrysler. They had a negative working capital in the industrial business of minus 11 billion in 2020. And of this negative working capital, 20.5 billion is related to trade payables to suppliers. And then you had the situation in 2020 that you had to finance operating losses, negative operating free cash flows, and then you had to pay your suppliers. And this increased the cash outflow significantly, and out from a 10 billion negative free cash flow in the first half year, 5.8 billion were related to this working capital issue. So this is something which was gaining a new dimension during last year. And the second most important outcome of 2020 was once again, like it was in 0809, that you need a decent or a strong automotive net liquidity in the industrial business, which is, let's call it a kind of life insurance for you as an OEM. And just to give you also a concrete example, we had 61 billion net liquidity in the European industry at the end of fiscal year 2019, and already 28 billion were burned during the first half year of 2020. And this gives you an indication how important this item is. And the good news is that at the end of 2020, we had a combined figure of 74 billion, which means 14 billion higher. So this is why I said at the beginning, it was a surprisingly strong performance. And this trend continued, at least from the published figure so far in the first quarter. German OEMs generated another 10 billion free cash flow, which improved this situation further. So interesting performance here.
So we spoke about performance.
Let me do one remark also on the suppliers and the KPIs, and also on the valuation. And these are suppliers which are not tech suppliers. This is a sample of 40 suppliers which are traditional component suppliers. And what we see on the next slide, please, is that we had, during the COVID crisis, we had, based on EV/EBITDA levels, we had trough multiples like we had seen in 0809. On an EV sales level, we were even slightly lower than this. And valuations have recovered in the meantime to the historical average, or even slightly below the historical average, as estimates for 2022 are back at the level which we had at the beginning of 2020, or even 3% higher than at this time. So this is, from my perspective, an indication that we have, or we are back in a normal situation for the industry.
So we spoke overall about performance in the past. What is true is that many companies, even traditional companies, are investing in communication and communicating about electric new vehicles, and speaking also about suppliers, not only traditional automotive companies. So what are, Georg, your expectations for the next future about performances on financial markets?
On financial markets, or on the industry perspective in general? If I would look into
even
the
in general.
In the next decade, especially on the European sector, I think that we will see an ongoing and accelerating convergence with the tech industry. Regina mentioned a few examples before. And I would say that at the end of the next decade, the European industry is certainly, to a large extent, electrified and autonomous. And why I'm saying this? So we have, if we look at the major trends, electrification, autonomous driving, and also the increasing importance of software, all of them will increase the interaction with large tech players, or they force the industry into a competition with them. So therefore, from my perspective, there will be a much higher interaction between both industries. And a few examples are, for example, that EVs have 2 times the semi-content like ECE power cars. Autonomous driving is really a catalyst for also increasing the semi-content. We have this huge amount of data generation. The higher the automatization level is becoming, the higher the data generation will be. And then we have this topic software, and the market for automotive software will grow significantly. There are estimates up to 250 billion until 2030. So therefore, it is, from my perspective, clear that there will be a much stronger interaction between both industries, and this convergence will accelerate from my perspective.
Last question for you, Georg. Many companies are investing in the United States. Many startups are listing on the financial markets, even through SPAC, not only traditional IPOs. So, do you think that in a moment like this, when central banks are pumping a lot of liquidity on markets, their future will be easier listing in the United States, and not, for example, in other region in Asia or other part of the world?
I would say that the most difficult part is being listed in Europe, unfortunately. But Regina mentioned a few examples before, and this is something from a European perspective. You have to admit that it is probably easier, better to at least try to IPO, try to raise some money in the US market, as the risk awareness is a different one from my perspective. And if we look at the mentioned topic, specs you mentioned before, most of the specs, I think it were up to 40 specs until the end of February. Most of them took place in the US market, and if you look what they have raised in terms of money, it was more than 23 billion US dollars, and nearly 90% of this money went into the major trends, autonomous driving and electromobility, which is giving you an indication how important this market access is. And also, if we look at some examples here at the slide, that some EV players raised money in the North American market, it seems to be easier. People seem to be willing to take a higher risk, and therefore companies like this, independent from the future, what Regina mentioned, and also from the lasting valuation multiples, it seems easier to get money, to raise money, and to set up your business model and to enter the stock market. So therefore, unfortunately, I have to say from a European perspective, you have to consider a US listing or a US market entrance.
Enrico Chiaparoli is the CEO of an international bank, Barclays. He's also an investor, a business angel. So first of all, you follow directly the European and the American market, I guess. And so what is your first comment on evaluation, even in this case, but of the tier one? Okay, not only the traditional companies, not speaking also even on automotive companies, but suppliers and tier one in general.
Well, you know, the valuation methodology has changed significantly. Can you hear me?
Yes, we hear you. Okay, it's okay.
So the valuation methodology has changed significantly in the past 24 months, I'd say. So we usually value these companies on an EBITDA basis, as Georg showed, going back 10, 15, 20 years. And that multiple was highly correlated with the EBITDA margin. So the important thing for investor was selecting the right supplier that had the high margin, which was considered a sign of high quality of the business and attracted a premium valuation. Revenue growth was not correlated until a few months ago to that multiple. The growth in the business was the growth of the automotive market, secular long trend of growth with cycle in it. Now that has shifted a little bit, and if we run that same correlation analysis in the recent 18-24 months, we find that growth actually has something to say in relation to being a premium valuation or not. And the reason is that some of these tier one supplier are producing products that relate to the internal combustion engine, which investors now see as a defunct product, a product that will not be around 20, 30 years from now. And so only those that actually have developed or are developing new products into the EV value chain, and then the market expects them to experience significant growth, then those get a part of the premium valuation. Margins are still very important, but growth is now playing a role in the established valuation methodology because the participation or not in the EV value chain at the moment, or for that matter in the autonomous driving value chain, has become important. And we see in tier one supplier the same disruption and divergence that we see into OEMs. The LiDAR companies that Regina was mentioning at the beginning of this session are effectively suppliers, tier one supplier that are supplying or will supply a new product that was not part of an automotive, of an auto, of a car. It's not yet part of a car, but will be part of a car in few months or years when autonomous driving will be fully developed. So clearly in the supplier space, we find the same divergence that we see in the OEM space as well.
Now with the point of view of the investor, Enrico, how do you judge this divergence between evaluation on different regions? I mean, for example, United States or in Europe or in Asia. There are many startups that from China arrives in the United States through a SPAC. But anyway, there's a big difference between evaluation multiples in Europe, for example, on the United States. It's directly related to the sum, the amount of liquidity on the markets, or for other reasons that you see?
Well, there are a few reasons, but let's not forget that before the recent boom in SPACs in the US, Italy and the UK also had a significant number of SPAC, similar to what happened to what was going on in the US until, let's say, September of last year. It's just between September and March that the US SPAC market actually ballooned to an extreme size, which is now uncomparable to anything else in the world. So we have had situations in Italy with SPACs that have taken companies to the public market. The difference is that what we have seen happening in the US after the extreme rise in SPAC flotation started to happen last year is that we saw pre-revenue companies, so companies that are not yet producing revenues and cash flow, being listed. Which is something of a novelty and has allowed the startups to actually fund their business plan in the equity market, even before being able to report any revenue at all. So I think here the trends at play are a couple. One is clearly the Fed monetary policy, which has clearly been very loose, but it's loose here in Europe as well. So it's a factor, but it cannot be just the only factor. I think there is a difference in perception, in the risk perception and risk appetite in the US compared to Europe. In Europe, the SPACs that have existed in the past 10 years have taken public cash flow driven companies. So companies that had cash flow, that were generating cash, that were traditional, if you wish, companies that had already found their place in their market. The risk appetite of the US SPAC is what makes the difference and what allows startups in the US and Europe to actually get the capital they need to fund the energy transition and the automotive disruption. Let's not forget that Arrival, it's a UK company that listed via a US SPAC. Wallbox was announced a couple of weeks ago, is a power charging company that is a Spanish company, which has become a listed company in the US. So the risk appetite in the US is greater than here in Europe, but that is benefiting European companies as well.
Thank you, Enrico. Gianluca Camplone is head of automotive, senior partner of McKinsey. And how do you address to this subject, and how do you evaluate this difference between evaluation? I mean, there are many startups that have got very big evaluation, but they have no net income, little big and compressed revenues. Is a sort of misperception of their future, or what? Or even in this case, is the amount of liquidity that have to this stream has to find a place to go, a place to arrive?
Yeah, I think Regina and Enrico said the most of it, but I like to say this is like a terminal value game. I mean, terminal value always had a role, of course, in share price and in stock valuation, but historically it's been what, 30, 40%, and 60, 70, the value of cash flows. Now it's the other way around. And when the terminal value is that big, it is also very sensitive to the assumptions you make. So it's very easy to get an overwhelmingly relevant terminal value which justifies evaluation. My sense is, I wouldn't say this is a bubble, but there are some elements which are common to the 2001 era, which is, as Enrico also said, basically investors are they're keen to take on more risks. And they're valuing, especially for the startups, they're valuing prospective revenues. But the fundamental difference, in my view, is that the 2000 and 2001 internet bubble had no technological foundation. In this case, I think there is a technological foundation. There is an established battery technology. There is a clear roadmap on how to evolve the batteries. There are clear capabilities and a clear roadmap in terms of autonomous drive, artificial intelligence, and robotics applied to automotive. So I think while I see still some elements of overvaluations in some companies, but maybe this has to do with certain optimism and euphoristic approach to evaluations. But on the other hand, I'm confident that there is a technological foundations that we can build upon.
But what is clear is that once we had only Tesla on the market as a disruptive future for the automotive project. Now there is a crowd. Okay, so do you think it's more valuable for a company or a startup right now to invest, to stay being based in the United States with their condition on the markets, for the investor, also for private equity firms, for example, or venture capitalists, or stay in Europe or in other parts?
Yeah, I think as Enrico said, North America has been historically more risk keen, so to say. So this is an important element, and it's also been an historically innovation-oriented market. So certainly I see, maybe not easier, but certainly there is a more fertile ground for those startups to blossom, to get started in the US. And in the end, this turns to be also a competitive advantage, right? Because going public through SPAC or whatever into a large market, innovation-oriented, future-oriented like the US, which implies higher valuation multiples, gives those companies particularly high market capitalizations, which means easier to attract talents, better access to capitals, M&A from a position of strength. They can do paper transactions, they can acquire, diluting the shareholders, because anyway, large capitalization. So yes, I mean, all this, in my view, gives US-based startups and companies a certain advantage vis-a-vis the European peers. But on the other hand, I think there is also much higher pressure in the US. I mean, the analysts, capital markets, investors are particularly demanding, and this might put excessive pressure in the short term, as opposed to a balanced short-term, longer-term pressure, expectation, which might mislead companies, right? And we've seen some of the recent cases of misleading or even scam statements by those companies. I mean, these are just the results of a rush to please investors, a rush to get the valuations they want, and a rush to get access to capital. So, pros and cons.
Last tips from you, Gianluca, because I read that Volkswagen, for example, communicate that they're going to invest more than 50 billion on electric vehicles in the next 5 years, I guess. So they're growing in terms of automobiles sold, but they're growing also on financial markets. My question is, are we sure that the dinosaurs, we could call them like this, are going to disappear?
I don't think they're going to disappear, honestly.
On this battle, I mean, on this battle in the electric vehicles future.
I don't think at all they're going to disappear. They're ultimately going to probably dominate this, but it might take a bit. Well, I think they're waking up, and probably in terms of total return to shareholders, they could have done better, but ultimately they will come.
Time is running out. Regina, last tip from you. I was reading yesterday, preparing this panel, that right now on financial markets, electric vehicles companies, their value is quite the same of traditional companies on financial markets, but the net income is maybe 130, more or less. Okay, so what is the future? And how do you judge this divergence, this difference, this asymmetry?
Yeah, I mean, I think traditionally the markets have been skeptical that the incumbent players were going to be able to manage this transition. And I agree entirely. I think that they have woken up, and I think you've seen that in the massive amounts of capital that the major players have said they're going to be investing. And I think you also see announcements like, GM declaring that they're going to move away from ICE entirely by a certain year, and Ford electrifying their, crown jewel with the F-150. You're finally seeing that the OEMs are truly committed to this path. And so it is like they've finally woken up, and I think they're going to come in strong, and they know how to build cars, right? So I do think that you are likely to see them being very significant players in this market. What I also think, though, is that is going to be a hard transition. Whereas a new player has to build a vehicle, has to build the infrastructure around it, those are sort of known problems to be solved, and if you throw enough capital at them, you can make those problems work their way out. The issue that the incumbents are still burdened by is that they do have to transition their business, and they all have significant footprints and significant investments in ICE production facilities and technology, and how they manage that transition away from ICE and that legacy operations into the new era of electrification and connectivity. That is the part I think that investors think creates a little bit of a drag on valuation. But the more that the incumbent players prove that they're committed to this path and that they're going to be able to manage that transition, the more I think you'll see their valuations start to uplift. You candidly already see that in some gains that Volkswagen, GM, and Ford have all made and their valuation trading levels after they've made these big commitments. And I think you'll continue to see that through the incumbent OEMs. At the end of the day, I think they actually probably will be the dominant players in the landscape over time, with some of these new entrants also being successful. But I certainly would not count those players out.
Gianluca, for example, an idea. QuantumScape, yeah. They communicate more than they produce solid batteries, okay? They had an IPO on 27th of November, and on Christmas, the market cap was the same as Ford. Okay, so, for example, how do you judge? How is it possible?
I wouldn't comment on
Is it a normal market?
I don't want to comment on a specific situation, but like I said earlier, there have been a few cases of maybe overly optimistic statements, which basically found fertile ground into this, risk appetite, particularly in the U.S., and forward-looking type of investment logic, particularly in the U.S. But I think those are deviations and exceptions to a trend which is clearly set. I mean, those technologies will be shaping the future of the sector. Now, yes, there might be some volatility. For sure, there will be some volatility up and down. It is true. But by the way, back on your point on the established OEMs or the dinosaurs, as you said, I think we should always keep in mind that in a very best scenario for electric vehicles, more than 60% of the vehicle sales by 2030 will be in some form, they will have some form of combustion engine. So it will be hybrid, plug-in hybrid, essentially. In a plug-in hybrid, there is a combustion engine. The vehicle architecture is still the traditional architecture. So of course, if you're starting a company now, if you're starting a car OEM now, of course you start full electric. You have zero legacy. You have to set up the tooling from scratch. So you would start full electric. But put yourself in the shoes of a Volkswagen, Stellantis, one of the established OEMs, 120 years of history, billions in invested capital, in tooling, in 50, 60 factories globally, up and running. You have to feed those factories. I mean, and they are producing cars that people are buying. And people will be buying those cars still in 2030. So I think we have to be realistic that we're not switching to electric tomorrow morning. And the market will probably, before it becomes 100% electric, is going to take maybe 30 years.
I'm sorry because I got many answers and time is really running out, but I address to Enrico Chiapparoli. Do you think that this tremendous appetite for investments that funds, mutual funds, private equity firms has in this moment is going to finish with growing interest rates by central banks in, I don't know, next few months, next year and a half, next 2 years?
Question for me?
Question for Enrico.
Okay.
Are you there, Enrico? No, we've lost Enrico. Okay, Regina.
I'm here. Can you hear me?
Okay.
No, I'm here.
Okay. Please, Enrico. Did you hear the question?
So I think that there will be, there's just a delay on the line, but I can hear you. So I think that the interest will continue. And I think that there's still 400 SPACs with $130 billion to be spent. And so some of that will find its way into mobility, into energy transition. What is more difficult is the private equity. Few private equity actually invest in this space. And I think that's a part that will not change. For large transaction, there's only one or two private equity that can be involved and that like this sector. And I think that will remain the case. But for the SPACs, there will be continued appetite. It might be volatile, as was just said by other panelists, but it will continue.
Okay, thank you. Please, Regina, close this panel with your view, your comment. How do you think that even in this case, central banks could impact in the near future on automotive sector and in general, overall on financial markets?
I mean, I think the biggest piece here is just loose monetary policy obviously creates more capital that is going to flow into the system overall. And it is what is sort of fueling, I think, the greater risk appetite and this chasing of growth and this chasing of returns in a different way. And so when there are changes to that policy, you're going to see a direct impact into, you know, what is the premium that investors are going to require to take that incremental risk on these types of assets. And if those rates go up, and they're still with this premium, then that's going to compress valuations, right? So that's the biggest impact I see overall, is that, you know, on that monetary policy, as you alter sort of what people's risk appetite is as they're chasing growth, that will impact, you know, people's attractiveness of these type of assets.
Our time is out. Thank you very much to all of you. Regina Savage from Morgan Stanley, thank you. Thank you to Gianluca Camplone, McKinsey, Enrico Chiaparoli, Barclays, and Georg Sturzer from Unicredit. Thank you, thank you, thank you. And
Thank you.
see you on the next panel here in Motor Valley Festival. Thank you.
Thank you.
Thank you. Bye-bye.